Welcome back, investors, to Ticker Time News. I'm Adam, and the stock market started today in rally mode with a gap up right over its weekly expected move. This marks 3 weeks in a row that the weekly expected move has been blown out of the water. This week, though, it was to the upper edge of the weekly expected move, gapped right up above it, and it did not look back, carrying on with the upside momentum that it's enjoyed over the past few sessions, and ignoring, as it previously has, at least in the past couple of sessions, the hawkish-minded Fedspeak. The major indices finished near their best levels of the day. Look here at the 5-minute chart for the S&P 500. You can see it all occurred this morning. There was a gap up this morning right above the weekly expected move, and then it slowly climbed throughout the day, filling in again this gap that was left open right here. By 1 o'clock this afternoon, that gap had been filled. It did find a little bit of resistance in that gap once it broke to the upside of it, but it finished the day way above that at 40.67. And that is an important number, 40.67. And I'm going to talk about why that number is important and what the next target number should be for a bullish continuation of this move that we've seen over the past 3 days, and the next target level if bears take over again and push this market lower. Now, there was light volume today. I do need to point that out. In relative to the past couple of sessions, today was pretty light volume. As a matter of fact, if we look at the volume for today, let's slide this over so I can get that readout. Volume was 2 billion. Now, the average is 1.9 billion. So it was above average. But the past couple of days, if we look at yesterday was 2.3 billion. So volume levels went down today. Even though it was a shortened week, Friday, it went down. So we do have to point that out. That is interesting, to say the least, about how this market is reacting to this bullish run that we seem to find ourselves in. Now, the S&P 500 and the Nasdaq Composite both reclaimed a positive posture back above their 50-day moving average. Why is that important? Because it is bullish above, bearish below, on that 50-day moving average. That's why that was a very important level for both of those indices to take out today. Now, in our trade setups list that went out this morning, we reiterated biotechs in that trade setup list. Now, IBB is one of them. Let's pull that up here on the screen real quick. It was up 7.7% over the past 3 sessions when we first called out biotechs and said it's got to hold, Tuesday's low, and then this thing could really be on fire. And we've got 7.7% in the past 3 sessions that we have been in. I do have an update on where I think biotechs are going to go next, but first let me pull up XBI. That is the second or the other biotech ticker symbol that we specifically called out this morning. It has been up 8.4% over the past 3 sessions. Now, both of these tickers, they have found resistance at their 200-day moving average. And they'll likely start to cool off a little bit now because they have reached that level. It's going to take quite a bit of a volume increase in order to break that resistance line. You can see the last time XBI broke that resistance line, the 200-day moving average, it didn't stay above it very long before pulling back down and then using it as resistance right here. So we could see cooling off in the biotech space, at least for the next couple of days or next couple of sessions. We're heading to a weekend now. Yes, a funky market today. It was indeed. Funky indeed. So yeah, biotechs, I think they're going to cool off a little bit now. They probably won't be on our trade setups when it comes to Monday. Now, in our technical analysis of the S&P 500 this morning, we mentioned that the weekly pivot and I'll pull up the SPY for this one, even though I'm going to talk about the S&P 500 numbers as a whole here. The weekly pivot lines, they matched up with the 50-day moving average. And on the SPX, the actual S&P 500, that was right around 40.25. And we closed above that, right? And on the SPY here, we closed at 406. That is good. We got above that 40.25 or 402 on the SPY. That was a very critical level for the SPY to break above. So that was, it isn't anymore, but it was the current key inflection point to monitor. But we have broken back above that. We are above that 50-day moving average. Now, if it decisively surpassed and held that mark, that 50-day moving average, which it did, then we're looking for the August 24 through 26 breakdown. Now, looking here on the chart, where was August 24 and 26? Well, that's going to be this level right here, okay? And then the 26, that's Jackson Hole, right? Which is right here. In between these two markers, right? The SPY, it needs to break above that point, putting it right about here. This is our next key level for the SPY and for the SPX. Now, for the SPX, that's 41.25. That's our next upside target. I forgot the word for a moment. Our upside target. For the SPY, that's about 415, okay? So for the SPY, 415. For SPX, 41.25. That is the next upside target. If the bulls remain in control at the beginning of next week, which I'm not sure they're going to do, and I'll tell you why in just a moment, that would be the next target level, okay? Now, if bears come in and take over, sellers would need to knock the price back down below the 390 level on the SPY, which the 390 level is right about here, which was that bottom on September the 6th, or 3,900 on the SPX, okay? Those are the two levels. If bears want to take back control, they've got to break that 390 level on the SPY and 3,900 level on the SPX. So there's your two targets. If you're a bull or a bear, there's where we need to go next for those two sidelines. All right? Okay, let's keep moving on and talking about today. We also mentioned that despite September's reputation for being one of the worst performing months of the year, it's off to a decent start, as bulls have held support since that 3,900 level, and they took back control after 3 weeks of heavy distribution. 3 weeks of heavy distribution. The bears had it. They have it no more. Now, granted, there is still plenty of time left in the month for the bears to act, or for the month to go down and be poor, right? With a CPI report on the 13th next week and an FOMC meeting on the 20th and 21st, 2 weeks from now. Those two events have the thunder to really wreck this market or send it higher, right? And if this market did go higher, let me go over to the SPX for a second. If the SPX, the S&P 500, broke that level, then the next area that I think we would go is this trend line right here, where the S&P 500 found resistance before. If I mark this out, let's go to Let's go to Friday the 16th. That level would be 42.61. That would be the next level that bulls would need to be really concerned about, and bears would need to pile back in to find resistance there. Okay, so while I'm not thinking we're going to get there anytime soon, I did not expect today to gap right up above the weekly expected move. I did not expect that. That totally caught me off guard this morning, but it happened. So now, with the market rallying over these past 3 sessions, the burden is starting to shift onto the shoulders of the bears for now, right? They have got to put it to work if they can. Now, if you would like to get our trade setups and our technical analysis, simply click the first link in the description to get our weekly expected moves, trade setups, top 10 list, and more. Plus, our Discord server is up and running for our investor community. That's the second link in the description. So, what catalyst helped advance today's market? Well, a weakening US dollar. That's for one. Let's pull the dollar up here and look at that for just a moment. The US dollar index was down 0.7% today to 108.98. It was a big fall after the dollar broke 110, right? The dollar broke 110. I couldn't believe it. And we said that the dollar would need to get above that 109 level in order to continue this rally, but it just couldn't. Once it got to that 110, that dollar got too hot and it had to back off some. And it did. 2 days ago and today, it backed off. What else contributed to today's rally? Well, encouraging price action with stocks trading over the past 2 sessions in the face of bad news, which fostered a sense that the bad news, specifically the near-term rate hikes, may have been priced in already. I'm not so sure about that, but maybe. I really think this was just an oversold condition that we bounced from, because we were talking about this bounce for days before it occurred. We knew it was coming. So I really, at this point, don't think it was anything more than a bounce from an oversold condition. And if you look at the relative strength for where the S&P is right now, it's at a 43. A 43. That's not even up to the midpoint yet. That's still closer to being oversold than being overbought. Think about that for a moment. So it is moving its way back up to that 50 level though, but it's not there yet. So the relative strength is still a little bit on the weak side, and volume was light today. So just keep that in mind. What else contributed? A recognition that bearish sentiment had reached extreme levels. We talked about this. It's a contrarian indicator, I know, but we mentioned this in our market breakdown this morning for our investor community. We also mentioned it in our note that went out maybe 30 minutes before the live stream. Again, to our investor community, we mentioned it in there again. Extreme bearish sentiment, extreme levels. That is a contrarian indicator, but it's an indicator nonetheless. I think people are front running a good CPI. My calls I picked up at 395 went crazy. I bet they did. Absolutely. Front running a good CPI report. That's an interesting take. I could see that. I could see that too. People see oil, for example, coming off its highs. That's a big indicator that, wait a minute, maybe CPI is coming down. Maybe. Now, core CPI doesn't include energy. It doesn't include food. So what's housing doing? Well, housing has been cooling off too. That will help CPI to come down some more. So yeah, I can see that point, that investors are front running a positive CPI. That does make sense too. Now, what else happened? Leadership from growth stocks. They were better today. Why? Better than expected earnings reports from DocuSign, which DocuSign, it was up 10.5% today. Who would have thought DocuSign had good earnings or would have good earnings? Also, Zscaler, they had great earnings too. They were up over 21% today. Those were also good, or I should say, they also provided good leadership for the mega cap growth stocks to push them higher. I mean, this market has been front running a lot of things this month and drastically front running LOL. Yeah, absolutely. Totally agree 100%. Our whole summer rally was front running a Fed pivot that will not happen in 2022. Period. Will not happen in 2022. And if I'm wrong, I'll have to eat a leather shoe live on a live stream or something, because I do not believe the Fed will pivot in 2022. And we already have a Fed president. We already have a Fed president saying that, well, we're not going to cool rates in 2023 either. So take that with what you will. But the 21st, when Jerome Powell comes out and talk, whether we get a rate hike of 50 or 75, if we look at the CME tool, let me pull that up here real quick. CME Fed Watch tool, just type that into your search. Boom, countdown to FOMC, Fed Watch tool. This will show you the probability of what the next rate hike looks like. They also go into future FOMC meetings. You can look all the way down the line if you want for, I believe it's a year or more of FOMC meetings that they already have mapped out. Now, of course, the further away you get, the less predictive they are. But look at this. The last time I pulled this chart up on a live stream, we were sitting around 76% for a 75 basis point rate hike. We are at a 90% probability of a 75 basis point rate hike right now. There's only a 10% probability of a 50 basis point rate hike. So this, market participants obviously think that the probability of a 75 basis point rate hike is already nailed in. They've already written it in with pen. There's no whiting that out. So, yeah, that's something right there. And actually, what was it? 1 week ago, okay? 1 week ago, the 75 basis point rate hike, which is your biggest candle right here at 90% today, was at a 57% probability 1 week ago. 1 week ago, it was at 57% for a 75 basis point rate hike, and it's at 90% today. Yeah. Tell me your comment there, the market's front running. Yeah, they are front running. They think they got it in the bag, don't they? Boy, reality struck them at Jackson Hole, and now they're like, what reality, right? We see what we want to see. Man, it gets me going. It really gets me going. All the indicators show that the economy is slowing down. This market is expensive, and the market will pull back more. We have not seen the low yet for the year. But, to be fair, you do have bull runs and bounces and so forth in a bear market, in a downturn. And I think the number one problem with market participants not seeing reality is the fact that for the past 14 years, the Fed has always been there to pick the market up when the market trips. The Fed's not there anymore. The Fed is not your friend. All right, what else happened today? The S&P 500 and Nasdaq, like I said at the beginning of this live stream, they are back above their 50-day moving averages. It's a positive sign. I have to give them that one. That is a positive sign. Bullish above, bearish below on the 50-day moving average. Now, when we look at the sector breakdown for today, let me pull the sectors up here. All, as you probably guessed, all 11 S&P 500 sectors ended in positive territory with gains ranging from, let's see here, we've got XLU up 0.4%, that's utilities. And we have got XLC up, let's see, what was that again? There it goes, at the very bottom of this chart here, up 2.8%. That's communication services. So that was our range today. Energy today, it was up 2.4%. Second place. Energy was up today 2.4% in second place, but yet the market took off as well. Does that make sense? Does that make sense? Let me go to oil real quick. U.S. oil, okay? U.S. oil, that's the ticker symbol I use for trading view to get in here on oil. All right, looking at oil today, it was up 4.2%. We were so worried about oil breaking down because on, let's see, that would be Friday, Thursday, Wednesday, oil fell 5.7%. Getting down, the low of the day was 81.54. And everybody, even myself, I thought, whoa, a breakdown this low, it got me rocking. It really did. And I even said during the live stream that day that I may have to update my market thesis because oil has fallen so hard. But it picked back up today. It picked back up today. It closed today at 86.19. That's still close because it's that $85 a barrel level that I think is the support line. A break below 85, that makes me nervous that maybe I might have something wrong in my market thesis. And I may need to update that market thesis because of that. So make sure that you are also always staying fluid with your market thesis, with your idea on what the market's going to do, even if it's just on a stock by stock level and not the grander scheme, the wider market. Make sure when you get new data, you take that data in, you stay fluid, you update your projections, your thoughts, your ideas. Always stay fluid. Stay real, right? Stay based in reality too. Okay, let's keep going down this. Today's leadership, it was rooted in cyclical sectors and was reflective of a risk-on disposition that also sparked a rally in cryptocurrencies, right? Let's pull up, let me swap this sector over here real quick. Let me just pull up Bitcoin. It's at 21,390. Nice big move today. 10%, 10.6% right now. Ethereum is at 1719, up 5%. This is a big old move for Bitcoin. A positive one too. It actually took it out of my zone that I have here for Bitcoin, which is 16,000 to 20,000. I think this is where it's going to build its base for its next bull run. Now, I do have a target over here, that yellow circle. I was wondering if maybe this could be the absolute bottom. Maybe, maybe not. I'm not holding this one, 100% like I'm stuck on where I think the S&P 500 is going, because I'm not as knowledgeable when it comes to crypto as I am in the equity market. But I still track it. I have fun with it. There is a big a big level of volume when Bitcoin gets sub 19,000, maybe down, close to 19,000 even. And then when it gets up to about 21,600, there's a lot of selling that steps in at that price point. And we're almost at that price point right now. I'd be real curious. Today's high, 21,616. Yep. So, I mean, that is spot on right there. And I'm using the volume shelf profile. That's the green and yellow indicators, candles over here on this side of the screen. There's a big spike between that 21,600 and then going all the way down to about 19,000 even. That's like where Bitcoin's been going back and forth between for a while now. Going back to June the 13th when it fell 15% and then started trading in that range. Now it's gotten a little bit out of that, especially here during the summer rally, the end of June, beginning of August. But yeah, it pulled back to that level. So cryptocurrencies, they were also a good spot today. Then we have value versus growth. The Russell 3000 Growth Index was up 1.9% versus a 1.4% in the Russell 3000 Value Index, nearly identical. The CBOE Volatility Index, it was down 3.2% today to 22.85. That's where it closed. Now, it's still in the 20s, so it is still elevated. We can have volatility show up at any time, but it did fall. And it fell, over the past 2 days as well, the past 2 sessions, past 3 sessions now, count Friday. Market breadth today, it conveyed the broad-based buying interest as well. Advancers led decliners by a 5-to-1 margin at the New York Stock Exchange and a better than 2-to-1 margin at the Nasdaq. And then mega cap stocks, they were leadership stocks today, absolutely, providing influential support to the broader market. The Vanguard Mega Cap Growth ETF, ticker symbol is MGK, it was up 2% today. Compare that to the 1.4% gain in the Invesco S&P 500 Equal Weight ETF or the 1.5% gain in the S&P 500. Now, even though the Mega Cap Growth ETF did not break out of its weekly expected move, which was right about 203, it closed at 201, and there's this trend line that I need to extend here that it's been acting as resistance on the way down, but let me get that there. It did close above that today, and it did close above its 50-day moving average. Again, that's positive, just like the indices closing above the 50-day. Now, the lone economic release today was the July wholesale inventory. Really wasn't a big deal for the market. It came in up 0.6% month over month. Expectation was 0.8% gain. But this is down from June. June, it was up 1.8%. So a little slowdown there. Now, there won't be any U.S. economic data of note on Monday, but Tuesday will be a big day. And Tuesday will feature the August Consumer Price Index, CPI. That will be a market mover in the coming week, knowing that it's going to shape the market's perspective on the inflation trend and the Fed's potential response to it. So circle your calendar for Tuesday, buckle up for Tuesday. It could be a wild ride. Now, where could CPI come in on Tuesday? I'll do some research over the weekend. I will talk in more detail about it during Monday's live stream. 8.4 is where we were last time. 9.1 is where we were before. Now, remember, back in March, and I know commodities are completely different now than they were in February, March, April timeframe. But March saw inflation come down a little bit. That's where we got the snapback rally from in March, that snapback rally. Let me go back to the S&P 500 here, and I'll point it out. I mean, you could see it right there on the edge of your screen from the mega caps rallying. Where's my highlighter? It's this snapback rally right there at the end of March into the 1st of April. CPI ticked down. The market rallied. Our last CPI report ticked down, but 8.4 is still incredibly high inflation. And that's why the Fed will not pivot in 2022, because inflation is still too high. And they have a mandate to get inflation down to an average of 2% a year. So the Fed is not going to come off the pedal any on hiking rates. As you saw with the CME FedWatch tool, there's a 90% probability of a 75 basis point rate hike on the 21st of September. Now, CPI next week on Tuesday, what if it ticks back up? What if it ticks back up? What's the market going to think then? Jackson Hole was a, slap in the face, wake up to reality, cold water splashed on your face type of move when Jerome Powell said, whoa, we got to get more aggressive. This ain't good. So I don't want to be too big of a downer on a Friday night, but I just want to point that out. Okay. That's everything that I wanted to cover today. Thank you guys so much for being here with me. I greatly appreciate each and every one of you. If you do have a question, plug it in now. Otherwise, have a fantastic weekend. Investor community, I will see you over the weekend with some notes and communication. And if you could do me a huge favor, click the like button, share this video with a friend. Those two things really help out this channel. And if you like this perspective, you want our trade setups, our weekly expected moves, which come out every Sunday evening on 40 products. Want to add more? Top 10 list like value, dividend, growth, and momentum stocks. Market insight, just click the first link in the description. Do you think CPI comes down? That is a good question. Commodity prices have started to fluctuate a little bit. Home prices have started to come down some more. Let me just plug in oil again. This is a big indicator right here, I think, for CPI. As we have seen with oil, it has come down significantly since this June peak, right? It dropped significantly. It bottomed in August. Now, if we go back to July, a month ago, this drop in oil, it was just over halfway. And when I'm talking about the drop in oil, I'm specifically talking about this drop right here in oil. If we go to a month ago, when CPI came out, it was about here. Well, my apologies. The August read, okay? A month before the August CPI. We're going back to July. We were just over halfway through the fall in oil prices. That fall didn't show up in the CPI fully until it took 2 months for that to fully show up in CPI. So if we look at what's happened since August, right here, oil, at least half of that time, went up, right? We had this reversal and rally in oil. Now, oil has come back down and it's sitting around that, $85, $86 a barrel right now. And when we look at the August read on oil, it was somewhere around $85, $87 a barrel. So we're about at the same, but we did have that fluctuation where oil went back up again. Is that going to show up in this CPI report? I think it will be next time, right? So what I'm thinking is, let me clean this up again here. When it comes to oil, and I know core CPI doesn't have food or energy, but if we're looking at August, okay, we're looking at from right here, and then where's the beginning? Where's the beginning? Okay, basically the peak right here. So we have this and then this bounce right there. That right there could provide a little bit of trouble, a little bit of stickiness for CPI to come down too far. Okay. Also, with commodity prices, other commodities kind of doing the same thing where they kind of bounced, went back up a little bit before starting to fall some more. So last month for CPI, I was concerned that housing shelter cost hadn't come down enough to affect CPI greatly. I was wrong. CPI came down further than I thought. Now, this time around, I see oil has come down. Oil did bounce. So now this has got me sticking on whether CPI can fall further. So this is my red flag. Last month, housing shelter, that was my red flag. This time, it's energy prices. That's my red flag. So since I was wrong last time around with housing, maybe I'm wrong this time and I'm just over analyzing and overthinking CPI. Now, in the to your point here about China's announcement, the note that I sent out to our investor community this evening, and actually I can go over here and pull the number up precisely. The note that I sent out to our investor community before I started the live stream, I specifically talked about China. It came out about an hour ago to our investor community. And again, if you want access to that, just click the first link in the description. You get all of our notes and everything. When I talked about China, let's see here. Okay, so China, China extended its lockdown. Excuse me. Let's see here. I thought I'd put it in here. Maybe I didn't. Maybe that was a different note that I'm thinking about. But you are correct about China. Well, I guess I didn't. Oh, okay. Here we go. I sent it out this morning. And it says this morning that softer than expected CPI and PPI readings for August out of China. That's what I included, that line right there. So that was this morning's note that went out to investors, where I mentioned CPI and PPI for China, softer than expected. So that can mean something for us, because just think about it. Think about how many products we get from China. So if China is slowing down itself, second biggest economy, then that must mean that America too, the largest economy, is slowing down as well and is cooling off. And if you look at our export imports, it was Europe that had an off balance. And if China isn't manufacturing as much, causing their PPI to come down, then we're not either. So just something to think about. But you are absolutely correct about China's CPI and PPI. I guess the PPI would be more concerning for us, or at least more relative to our own happenings in our own economy, since CPI is based on what Chinese citizens are paying. So yes, you are correct about that one. So in my mind, yes, I do think inflation has come down some more, but I do not think it has come down past 8%. I really don't. And I do have a worry that since commodity prices, including oil, had this run up right here, this rally, I mean, it was about April, goodness gracious, I'm getting all my dates mixed up. August 16th, and it peaked on August 30th. So for a good 2 weeks, or 10 trading or was it 10 trading sessions? There's no holidays, I don't think. 10 trading sessions, oil went up. So half of the month, oil was rallying. Other commodity prices were rallying. They were moving back up. They were getting more expensive. So who's not to say maybe inflation ticks down in September, but because of this rally in commodity prices in the middle to end of August, that October's CPI report doesn't tick back up, right? So if there was a 2-month delay in oil prices coming down before it showed up in the CPI report, then August, September, October, a 2-month delay before this rebound in commodity prices took hold. So now that I'm flushing this out, I'm thinking about it more. I'm thinking maybe that it affects October's read more so than our read next week. So yes, inflation will probably tick down on Tuesday. That would probably be my guess right now. But I do want to dig into it over this weekend and get a better opinion about it as we move into next week. But I do think, with my rationale here, I'm thinking that with commodity prices having that bounce middle to end of August, and there being a 2-month delay for that showing up in the CPI print, then that's October's read that could see inflation tick back up. All right. That's all I got for my thoughts on CPI right now. Nothing anymore than that. Okay. Any other questions? Anything else you want to talk about before we wrap it up for this week? Let me just clean this chart up here a little bit more and just give you a minute or so if you got anything else you would like to talk about. And I'll take it back over here. And I want to point out, if you have anything else or not, I'm going to go to the monthly view here for the S&P 500 just to give a little perspective here. But I just want to take these two green dot marks off of here. You are absolutely welcome. All right, when I go to the monthly view here, I might have to move that other green mark too. Yeah, things look totally different on a monthly view. But here's what I wanted to point out on this monthly chart, okay? Let me just take that off. Okay. If you look at the monthly chart, it doesn't look like much. However, you can see that we're starting to wedge here on a monthly time frame, okay? Also, right at this exact moment in time, the 5-day EMA would be about 40.69. We closed today at 40.67. So we are just under it. If we go back 1, 2, 3, 4, 5, 6 months ago, okay? 6 months ago is the only month that we closed above that line. So it's been 6 months now that we've been trading under that line. And the reason that I bring that up is because during the bull rally, right? If we just looking from March of 2020, because that was the last time that we were under the 5-day EMA on a monthly time frame here. That was the only month that we were under from then all the way until we fell under it in January. Okay? So the whole bull run from COVID to January, we used it as support. We kept bouncing off of it, bouncing off of it, bouncing off of it. But for the past 6 months, we've been using it as resistance, bouncing under it. We come up, we hit it, we fall. We come up, we hit it, we fall. Well, we came up and we hit it right now. And we are barely into September right now. Today's September the 9th. We have barely really even been into this month, and we are sitting practically on it right now. To me, that doesn't signal that there's a lot more room left for the rest of this month to be overly bullish, right? Now, last month, during the month, we ran all the way up above it. There's that big candle sticking up. Or I should say there's the big wick sticking up. The wick goes all the way up and it touches that top trend line, that red line that's coming down on top of the candles. The wick did run up and touch that, but the candle came back down to close under that moving average. So it is possible, I guess, that next week we could run up and then pull back down to it, leaving another big wick on top of the candle. I guess that's a possibility. But it's just something to note there. We have not reached the bottom of this market yet. I've said that before probably 100 times already. The recession is ahead. Okay? Paper recession that we're in now, it's not really affecting all that much. And another thing to think too that I've been thinking about this week, earnings. We have had record profits in earnings over the past couple of years. The comps or comparisons are going to be horrible for companies over the next year. Horrible. That will not translate into big bullish moves. And that's like, over the next year or more. Those record profits, they're going to come back and they're going to hurt because those comparisons, they won't be the same. And you may even see negative growth because of the comps. So just something I've been thinking about. The earnings are not or have not been affected yet, but they will. And that's over a longer stretch of time, like at least a year. So, all right. Yes, earnings. I assume these earnings will not sustain. No, they can't. I mean, if you look at the economy right now, growth is slowing. You cannot go record profit, and then the economy slow down and have more record profit. Math doesn't work that way, right? So that will affect earnings. And a lot of, especially retail, but earnings are compared to last year, compared to last quarter, right? They're always compared to, the previous quarter. They're always compared to the same quarter a year ago. And it's that same quarter a year ago that's going to be affected by comparisons. Because when you compare record profits like from a year ago, that maybe there was 100% growth, and then you get to this year where, earnings, there may be some earnings expansion in there, maybe. But if it's 10%, well, you had 100% growth in the same quarter a year ago. So 100% compared to 10%, that's not a good comparison. On paper, that looks like the company has slowed down dramatically. And that will be translated into the valuation of that company. So earnings are a whole nother thing that they haven't really affected this market that much, right? I mean, 2019 theory, I think, is legitimate for a slowing economy. And if you look at 2019, you know, where the market was at 2019, you know, the high was right here. This is December of 2019, and the S&P 500 was at 3213. It closed at 3230, as a matter of fact. 3230 is where the market closed in December of 2019. And that is awfully darn close to where my mark is for where I think the bottom could be for the market. 30. What was that again? My apologies. 3230. 3230. That's just crazy, isn't it? But talk to companies. Talk to managers of companies where you live. Ask them how business is doing. Some may say great. Some may say it's slowing. You look at RV industry. That's slowing. Look at the boating industry. That's slowing. In times of growth, those two sectors do wonderful. But when people start to pinch pennies, they don't spend their money on discretional products like buying a boat or buying an RV. They save that money. So both of those industries are already slowing down. That means growth is slowing down. That means that people are preparing for a tough go at it. Jerome Powell himself has said, expect pain. His exact word, pain. Have we really felt pain after a 14-year bull run of the Fed is your friend? I mean, from the pandemic low to the high in January, or I guess it would really be November, December of last year when it peaked. I mean, you look at the growth curve here, right? Pretty steady. We get to COVID, and you could really call this your blow off top before it all ends. And it's because of all of that unlimited QE, right? I can't pronounce it now. Unlimited quantitative easing, money going into the market. September was the first real month of quantitative tightening. That cycle has just begun. That's something else that the market, I don't think, is seeing reality on, because the Fed's been talking about quantitative tightening now for a little bit. The market has said, well, we haven't really felt quantitative tightening yet. Well, that's because they don't understand that $95 billion, September's the first month that $95 billion is coming out of the market with quantitative tightening. So that's something else that I don't think the market is seeing reality on. All right. Well, a wonderful, wonderful group you are. I greatly appreciate you guys. Make sure to click that like button, share this video, subscribe if you're new. We do this every day the market is open. And click the first link in the description. Join our investor community. Click the second link to hop on our Discord server. It is up. It is there. All right. Well, I think that will wrap it up for today. Yes, ladies and gentlemen. All right. We will. So, again, thank you for joining me, and I will see you in the next video. Have a wonderful weekend.